Good morning, everyone. How's it going? It is half an hour before the market is about to open on Friday, February 16th. So the only real big item on the reports today is that PPI. So we'll take a look at that. We'll see how the future markets are looking. And we also got one important earnings report that was on AMAT. We'll take a look at that one first, see how AMAT is doing. So we reported, and pre-market, it's way up here. So that will be a positive force, an upward force for the semiconductors and the technology sectors. We'll see how the PPI report came though. So given how the CPI report came out, I wouldn't be very surprised if the PPI report was negative. Okay, and so far insignificant. There's nothing much going on in the futures market. They're all relatively flat. You got the Nasdaq slightly up, probably being helped by AMAT, and then the futures are kind of down at the verge of non-random, about 32 basis points, 30 basis points. So Dow we'll keep an eye on, because if that stays pointed downwards, then we could get a down day in the Dow. That's a mouthful. So Dow, meaning the more defensive sectors, would be vastly underperforming the Nasdaq, and that would be interesting because that might be indicative of a sector rotation. Let's see how everything played out though, and we can see what the reaction was to that PPI. And the market really didn't like that PPI. You can see how in the aftermarket trading, we were actually up above yesterday's close. And then after the PPI report, we're about maybe a little bit below, or pretty close to exactly where we closed yesterday. A little bit below. So that's not good news for the markets, because that is a downward pressure coming from that PPI report. So we're really going to want to look at bonds and VIX, but we also want to see how big an effect this might actually have. So we want to compare this to the movement of the CPI report. And it shouldn't be as big. And if it's not as big, then it's not going to be a big deal, because the market just shrugged off that CPI report. So let's take a quick look at the index, S&P index. So here with that CPI report, that was Tuesday. And so there's that big gap down. And then we traded from the EMA 20 all the way back to the EMA 8. Where's the pre-market right here? I can't even see. 501.65. So yeah, baby reaction. It's not even, it's still above this red line, this psychological resistance. So there's no gap down per se. There is obviously going to be a movement from the close, but that movement downward is well within the bar that we had yesterday. So PPI, is it going to create a huge downward force in the market? It doesn't look like it. And maybe we'll go sideways, but I don't see us retracing back to this trend line right here. So if we get anything like the last couple days, it's just going to shrug this off and potentially even move higher, or even possibly in the same session. So let's see what that might look like. Let me just get back here. We'll draw a couple more lines. Could probably get rid of these. The last time I did that, we traded right back down. I should have kept the lines, but we're far enough away, and I'm not expecting a huge downward movement, especially since we have this blue line right here, this psychological resistance right here, that psychological, I guess I should say support. It used to be psychological resistance. It's now become support now that we're above it. So it's going to be a little bit difficult for the market to trade below this blue line, or at least stay below this blue line. We might trade through it, but for it to stay below the blue line, it's going to be a little bit more difficult. Let me add the lines for the current situation. Okay. So given that this pullback is a lot more mild than what we saw in the CPI report, uh, chances are we're going to be very close to the close. So any movement upwards to the previous day close is not going to be meaningful. So what we really want to see is at what point during the day, if at all, does the market pick a direction and very solidly with momentum break through one of these purple lines and then start moving with conviction. That might not happen. We could just go sideways. That is possible. It is a Friday, and there are risks that most institutional traders will not necessarily want to take over a weekend. But if the momentum is really strong, then we'll keep on moving upwards. Apple is looking like it's going to open a little higher. I don't know what happened right here. That was probably the AI hype that we talked about yesterday, where in the last couple minutes, Apple just had this extreme movement upwards in the after hours. It continued, and you can see that enthusiasm has really died off. And it wasn't really correlated with the 530. The 530 was just this little bit right here, it did go down, but then it's recovered. So it's mostly sideways. So all of this, undoing all of this was people figuring out, hey, we probably overreacted to this AI news. And this type of reaction is indicative of bubbles forming and bubbles moving along. So we want to be very careful with the AI stocks. We could still have several months of a bubble with the AI stocks, but you just got to be careful because that type of enthusiasm and this type of movement that we saw from the Magnificent Seven over the last year is really kind of overdone. Like if I look at NVIDIA over the past, since 2023, I think it started maybe more like March, but we'll just give it all of 2023. Okay, we're up 406%. Right? That's a little ridiculous, right? In over just 1 year, NVIDIA is up over 400%. So when does this bubble burst? Well, the dot-com era told us that it could last for a while, right? It could last a couple years. This could keep on going, but we want to be aware. So if we're playing around with names like NVIDIA, we want to be on the short term. So we're in, we're out when we make our target profits, or we want to be hedging ourselves along the way. If you want to, for example, if I was buying NVIDIA stock, not options, if I was buying NVIDIA stock, I'd be hedging. I'd be buying puts along the way too, protective puts, just cheap insurance relative to the amount of profits that I've already had inside of NVIDIA. So we want to be careful with stuff like this because you never know when a bubble is going to pop. There's usually not very many or not much advanced notice when that happens. It's some sort of news item, some sort of thing happens, but we're not at the super heated, crazy phase yet. When we get there, it is when we'll start seeing smaller stocks that no one's ever heard of just suddenly get bid up, or stocks that are brand new or maybe just 1 or 2 years old and they're already IPO'd and they're getting crazy valuations. That's most likely going to be the sign that we're going to pop. But something else could trigger that pop. So it doesn't necessarily have to get that far along for us to pop that bubble. Earnings, we've got earnings in a couple days on NVIDIA. What day is this? Wednesday after hours, we're going to get earnings from NVIDIA. That could be a mini bubble pop. So we want to be very careful with the Magnificent Seven stocks, with the semiconductor stocks, with the AI stocks, because NVIDIA is they led the way up for the chips. during the AI revolution. So we'll want to watch that next week for sure. But before I get too sidetracked, let's come back to today and just finish what we were looking at. So we had that downward movement. Let's take a look at VIX. Let's look at TLT. With this movement downwards, our Fed watch, we should really be quite a bit lower in terms of our probabilities of rate cuts, although I am not sure when this gets updated. Probably not before the market opens. I wonder if it tells me. So this is probably not during the day. Most likely this is going to get revised, and we would expect that to come even lower. If we look at May, we're indicating, look at this, 30% plus 2. Oh, that's 32%. Yesterday we were close to 40. It was like 38%, right? So yesterday was this 38.4%. Now we're at 32%. And yesterday I was commenting how it's within range, it's within a reasonable range, but I expected it to be closer to 30%. And we're there. And then today, when the market opens and this gets refreshed, it might go even lower. So that would put pressure on TLT. We would expect this to come down, and pre-market, it is down closer to where we were 2 days ago and 3 days ago. So if we trade right back into this region, then we're challenging that MA90 again. And then if we break below that MA90, that's going to be not great news for the market, especially the NASDAQ. I'm going to move this down from the level that we had it before to the lows of right here, which is basically the MA90. And if we end up going below this, that could be the trigger or the beginning of us starting to pull back on our indices. So we pull back once again to that EMA 20, and then we have another stab at breaking through that uptrend, and we'll see how strong and how resilient the market is and how many times. So the more times we touch, the more likely it is that we break through. The more times we test something, it makes sense, right? Because if I extend this line out for a year, can it keep touching that same line for a year? Every couple weeks, what is this, almost 2 weeks? Every 2 weeks it comes and it touches it. At some point, we know that it can't do it forever because we are a mean reverting market. And a mean reverting market means that it's got to come back to the moving averages. Unless all of these moving averages all converge and start following the exact same trend line, then what must happen is that we must come and break down below, because in order to balance out, in order to come back to an average, you've got to go through it. So we cannot bounce on top of a moving average forever. That's the definition of an average, right? If I keep staying above the average, then what happens is that average has to keep moving upwards. And then that average starts to go like this. It starts to go parabolic, and there's a limit, right? The limit is a vertical line, and we can't get a vertical line because we have to move day by day. It has to move somewhere. A price cannot move up infinitely in a single day. So at some point, it has to break through this uptrend, and in order to do that, the more times we touch it, the longer it goes on, the higher chance we have of actually doing it. So it's sort of like saying, if I have a 50-50 chance, then every time I flip a coin, I have a 50-50 chance. Yes, every single time is independent. And I have every time there's a 50-50 chance of us getting either heads or tails. However, if I string things together in a set of 1,000, there's almost a 0% chance that I will get all heads. So this is the same thing. The more times I test it, that's a coin flip. And I've just had 4 coin flips. This is along the EMA 20. but that EMA 20 was not on this trend line yet. So technically I've had 4, and the more times I flip this coin, the more likely it is that I'm going to experience at least one event that breaks it. So we'll just see. We'll just see how long it takes. So we have a lot of forces right now we've been talking about over the last 2 weeks that are showing us more and more that there is downward pressure that can help us break below this line. And we want to be careful of that. But however, I always need to bring it back to the larger picture because people get excited when I say things like that, or when anyone says things like that, and they just want to short the market. We're not doing that. We are above the trend line. We are following the trend. The trend is still up, and so we still want our portfolios pointed upwards, and then we want to hedge ourselves against the event that it breaks. And we don't flip our portfolios around and start taking shorts, or at least shorts independent of longs, until we break this trend and start actually moving lower. Okay, so we looked at everything. I think VIX. VIX is the last thing we want to look at this morning. Let me look at the CPC. We haven't looked at that in a long time. We're at 0.72, which is not quite, it's on the verge of being significant. And below 0.7 is what we would consider significant and would require a correction, but we're not quite there. We'll see what today brings. And so let's take a look at VIX. VIX is moving up a little bit today. Not a whole lot yet. And let's see, it might be muted. It just depends on what we do over here intraday. Are we going to head lower and test this psychological support, or are we going to move higher? And I wouldn't expect in the first hour, that's when we get a lot of volatility, people opening and closing positions. A lot of retail traders trade in the first hour, and we'll just watch that volatility, see if we get, and it's unlikely that we'll get any clear direction during that first hour. And if we do, we want to see if it holds after that first hour, because then the institutional guys will come in and they may completely reverse the direction. So if you're day trading, well, actually volatility could be in your favor. So I don't necessarily want to say avoid the first hour, but don't put on a high conviction directional trade for the entire day in the first hour. If you want to trade for a few minutes or for like 20, 30 minutes, an hour during that first hour, that's fine. But don't say, pick a point and say, hey, I'm going to 0 days to expiration. It's going to keep on heading downwards or going to keep on heading upwards through the end of the day. No, but you want to see after that first hour what direction we get with conviction in order to do a trade like that. So far, basically the message is the same that it's been the last couple of weeks. We're pointed upwards. We're going to keep our portfolios long. We're going to hedge against a possibility of a downside movement through the trend line. So for me, that would look like a weekend hedge, something that I put on today that I plan on taking off on Monday, because we are kind of far above this trend line. So if we pull back to the trend line, that's normal movement. I don't want to hedge against normal movement. I want to hedge against outside movement, non-normal movement. My portfolio should be able to handle normal movement by itself. It's the outside movement, the unexpected movement, the beyond standard deviations movement that I want to protect against. So if I'm driving my car and a rock comes up and dings my hood, I have a little ding, I'm not going to take it to my insurance company and file a claim, because that's going to be like $100 to repair, and it's not worth it. I'm either have a deductible, or even if I don't have a deductible and I go and I claim it, that's going to affect my premiums going forward. I don't take my car in to insurance, or I don't report to insurance for a little scuff or a scratch on the side of my door. right? It's that large damage that I don't expect to happen, that doesn't happen on my normal daily driving, that I'm going to take to my insurance. The same thing here. If we pull back to this trend line, that's normal. My portfolio should be able to handle that. And if it can't, then I'm too heavily loaded to one side, in this case, to the upside. So all of my, number one, I'd be over allocated, and I'm over allocated to the upside, so that when I pull back to this trend line, then that's a huge blow to my account, and I feel really bad. And I feel like I've lost a lot of money, or maybe I did lose quite a bit of my portfolio, percentage of my portfolio. You don't want that. Your portfolio should handle normal movement, and your hedge is there for non-normal movement. Okay, so it's less than 10 minutes to the open, so we'll leave it right there. Have a wonderful trading session, and I will see you in the post market.